Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So I was recently doing a movie marathon of the Scary Movie series, and one of the scenes that stood out to me in Scary Movie 3 was they were getting invaded by aliens and they're listening to something on their earpiece, and it's like the president's like, "What is it?" Right? And they just like, "It's some old Tupac, sir." And the president knows it's all eyes on me, and I was like, "Dude, I haven't listened to Tupac in forever." And I wasn't even a big fan of Tupac when I was a kid, but you know what? I thought I'd just give it a listen, and that's what I've been doing. I've been listening to All Eyes on Me, Ain't Nothing But a Gangster Party. I'm not the biggest Tupac fan, but hey, I thought, you know what? As I'm listening to this, I was thinking I should bring up what I've been doing, which is listening to some Tupac, do another Velocity Banking review, and have a little Velocity Banking party, which is what we're going to do today. So let's go ahead and switch it up to the velocity banking spreadsheet, and we'll go ahead and do that. All right. So, what is velocity banking? Well, we'll do another review because we always review the most basic terms over and over again. All of velocity banking is a debt payoff strategy using your line of credit as your main operating account, right? That's all it is, right? And so, two things that you need for it is number one is a budget. So, your budget is your debt payoff plan, right? So, you have income, expenses, leftover savings, and then you have to make sure in your expenses that you do a expense breakdown and list every single debt that you have, because the whole purpose of the strategy is to pay off debt, and the more debt you pay off, the more cash flow you get, right? So we're going to do that, and for this example, or today's example, we're just going to assume that this is a two-person household, or a household where two people make income, right? So maybe a husband and wife, or two awesome best friends who decide, hey, let's combine our powers like Captain Planet to for the greater good. Although there are very few people who doing friends with business will actually result in a positive outcome. And I learned this from I Love Lucy, because there was a friend. I'm sorry. There's a episode of, like, don't do business with friends, and old wisdom. I love old wisdom, especially from back in the day, because they were smarter than I think we are now. So, because too many people try to do business with friends, and then I'm watching an episode of I Love Lucy in the 1950s, like, whoa, Ricky Ricardo, you're so smart. Like, I don't. The wisdom that I hear from you, I never heard from anybody I know today, because everyone's like, hey, let's all do business together. But Ricky Ricardo, this is why I watch old TV, like movies like Scary Movie 3, and listen to Tupac, because that's just the 90s kid that I am. Okay. All right. So let's go ahead, and we did the budget. So requirement number two is a line of credit as our main operating account. So there's the main ones that we want to use are either personal or home equity. If you don't own a home, I would go for the personal. And if you for whatever reason can't do a personal, I'd resort to a credit card as a last resort. But if you have both a personal home equity and a credit card, that there's a way to do it so you maximize the effectiveness of it with a credit card, right? Because credit cards have advantages that personal home equity don't have. Okay, and I have all of them, right? I got personal home equity. In fact, I have over $285,000 in lines of credit. $285,000, right? So that's because I know the secret of what banks are looking for, or who they're looking to lend to. And I know that I say this every single video, but there are so many people out there who just don't know the secret. All right. And that's because banks don't lend money to people who need it. Right. And so people watch these videos like, who has a line of credit laying around? Oh, I got to delete these Macaulay Culkin pictures. But I like looking at the original clickbait face. But who has a line of credit laying around? And like, I do, because I got it before I need it. Or I got it because banks don't lend money to people who need it. And so you never want to do this when you're like, oh man, I totally need to borrow a line of credit. And even if you did, you probably do it wrong too. Because there are ton of, well, I don't want to say a ton of people, but there are plenty of people on Reddit, and I've kind of gone over these situations where they got a home equity line of credit and they're struggling. And the reason why they're struggling is because they're not willing to put zero in that savings, right? So we assume two things. Number one is the same income. Number two is we're not going to have any savings. So, Dave Ramsey is like, well, there's this baby steps, and baby step one, and he says like, oh, it works for everybody, which is save $1,000. And I'm saying, whoa, we're not going to do that, because we're going to have all our money go into debt with the help of a line of credit. Okay, and let's go ahead and do that. And we're going to have something called cash flow, which is income minus expenses. Now, it looks similar to savings, but if you look at my bank account every single month, I pretty much have zero. Like, you'll see a lot of money come in, a lot of money go out because it's all going to line of credit. And some people would freak out, oh my goodness, you don't have 3 to 6 months of savings? No, I don't, because my cash flow is going to be used to pay off the debt. Okay, my cash flow. And what we're going to do from day one is try to maximize our cash flow on day one. And we don't need a huge line of credit to do this, although the reason why people talk about home equity lines of credit is because it's the same thing as a personal line of credit, except that you're offering your home equity as collateral. So when you have some skin in the game, well, people will give you better terms and limits. And I know people are like, well, I don't want to offer any collateral. Well, you get the more expensive option, right? So, I have a home equity line of credit right now at like 10%. That's like the average interest rate, and it's $50,000, right? And so if you don't know what home equity is, basically there's something called the market value of your home. It's like the price if you put a for sale sign today in front of your home. What's the most likeliest price that you're going to get from a random stranger? I think the IRS kind of defines it a certain way like that, but not like I did. But basically, if you were to sell your home today, what would the price be, or what could you get minus the amount of debt that you have? So I paid off my home last month, so I got like a ton of equity. In fact, I got a lot of equity, but it's like, all right, I gotta kind of get a little bit more, but I still feel comfortable with where I'm at. So that's why like I'm not too, um, I don't feel the urge to get like 20 homes in one year, just because I can be effective with one, two, three, four homes, right? So let's go ahead and do this, and we'll assume that we have a $50,000, almost like a credit card, but it's called a home equity line of credit, and we're gonna move some debt. So we're gonna start with the credit cards one and two. So this is 15 grand in credit card debt. And again, work at with one debt at a time, right? So start with credit cards first because they have the highest interest rates, but not only that, they take up a lot of cash flow compared to the balance, right? So we'll talk about that later. And so once we just do the debt transfer, okay, then guess what happens to these payments? This is zero and zero. And now we went from 13 or 1200 to 1700, right, in day one without making more money. And the strategy itself is your pay goes into that line of credit, and then your expenses come out of that line of credit. And then you rinse and repeat over and over again, and then you pay down debt, goes to zero. Do it with the other loans, right? And we're going to talk about the debt order because that's really important. The most important thing that I would say is don't pay off the mortgage first, right? If you have a bunch of debts, and we're going to talk about that cash flow index that we always talk about, we don't want to pay off the mortgage first. And why is that? Because think about this. Let's go ahead and zoom in. If I focus all my energy and effort paying off that mortgage, $200,000, how much cash flow do I get back? $954. Yet I could pay this $22,000 loan and get half that payment. In fact, if I pay off these two auto loans, that's pretty much equivalent to a mortgage payment. So it's going to take me so much longer, right, to recover um, this cash flow compared to just focus on these and paying them off early, right? That's why we leave the mortgage last, okay? So again, this is what we call our cash flow, right? Right here. I got to think of another word for this. I want to call it like the debt terminator, the debt rebalancer. But I don't know if I have like a great name for it. Anybody who's listening to this maybe want to do a comment. It's like, hey, you should call this cash flow, the nickname for it is the debt, I don't know, terminator, right? So all right, so let's go ahead and get started with the actual strategy itself. So, three formulas, same three formulas every single time. It's you just do the previous month plus one, I2 plus one, right? And then to get the next month's balance, it's the previous month's balance plus the previous month's interest minus our cash flow, 1784.24. All right, and then what you do is to get the interest, you take the average daily balance. So there's an average function right here. To estimate the average daily balance, multiply it by the interest rate, which is zero point 0.1, and then you divide by 12 because the interest is calculated monthly, but they always quote it to you annually. So I remember when I first like 10, 20, 30% interest rates, I was so scared. And then I realized, oh, wait a minute, it's not that much when you divide by 12, right? If you get the monthly interest. All right, so now let's go ahead and do that. and then we copy and paste, and it's like, oh my goodness, in 9 months, we paid off our 15 grand credit card debt. And again, we're assuming that we have a two income household. So I think this might be reasonable with for two income people. Like maybe one person makes $3,000 a month and another person makes 4,500, right? So paycheck into line of credit, expenses out, and then same process over and over again. Use your entire paycheck to pay off the debt. And so let's go ahead and write our milestones right here, which is 8 months and 15K. Okay, so now we got to tackle these other loans, right? So credit cards are usually the easiest to kind of figure out what we're going to do with velocity banking. Although, sometimes you do have loans that eat up a lot of cash flow that maybe are like half a year to a year, and you probably want to get rid of those first. So one of the ways that we can figure out like which loans do we pay off is that we have this loan calculator right here. If you put in the original balance, the interest rate, and the term, like 5 years, 10 years, 1 year, you could easily figure out this monthly payment. Well, not easily. It's this kind of complicated formula, minus payment and then all this other stuff. And you have to enter in, what do you have to enter in? I don't remember. The rate, the number of periods, and what they call the present value or the original balance, right? See how these are all highlighted? So this is kind of like my cheat sheet here to figure out like, okay, what's the balance of the loans? And people are like, Excel's not sophisticated enough to figure this. Oh, it is, because they have a function called future value. So if you put in the interest rate, the number of periods, the payment, then you can easily figure out like, oh, after a certain amount of months, what's the balance, right? And so here we have something called the cash flow index. All it is a formula of the balance divided by the payment amount. And so think of this as a ranking system. So the lower the number, that's the one you want to pay off first, because think about it like this, right? So again, I already said it before, where it's like this number is so huge. Then the reason why this number is so huge is because you paid this $200,000 off. You will only get $950 of cash flow, right? But if I pay, let's say, these two loans off, the 48,000, I get almost the same amount. That's why I want to pay these off first. So we're thinking in terms of cash flow and not what mainstream society teaches us, which is only focus on the interest rate. Although this does have the highest interest rate out of all these loans. So let's go ahead and figure out what the current loan balance is. And this was at 8 months. So now we just kind of type in 8 here. So 8, 8, 8, 8, 8. And so you can see some of these loans went down, but this one went down a little bit. This one went down a little bit. Should we move all of these loans into the line of credit? You could pay them off one at a time. Might be easier, because if you have a $50,000 line of credit and you put this whole amount, I actually don't know how much this is. Let's just calculate that. So G2 plus G3, is it G3? No, G3. That's about 40 grand. And then if something happens and you need your line of credit as your emergency fund, um, it might, how do I say this? Uh, it might not be the best idea to fill up your line of credit to the max, right? So let's just go ahead and move this auto loan 2. Again, as technically a lower cash flow index, so 45.21. Again, and the thing with loans is that the cash flow index does decrease, because the balance of the loan goes down over time and the payment still stays the same. Where with the credit card, the cash flow index tends to stay the same, because the payment is a percentage usually of that balance, right? So something to think about. But let's go ahead and move this 19 grand into that line of credit, right? So 19, and I got to copy and paste, because if I copy it directly, then it's like using oh, whoopsie. Okay. I got to paste the values, right? So I'll probably use this one. And yeah, the values. And so the reason I'm doing that is because if I don't do that and I copy it here, then it's going to mess up, because it's actually copying the formula. So now what do I do right here? All right, so now what we do is we add that. Oh, it's screwed up. Okay, so never mind. Maybe I'm not as sophisticated as I thought. 194. Oh, okay, 19461.96. So this is plus 19461.96. Okay, And just by simply moving this balance, right, into that line of credit, we get $430 back. So if we go back here, and we essentially paid this one off, so this goes to zero. And then what's our cash flow now? It's $2,214. Pretty good, right? So now let's go ahead and rinse and repeat over and over again. Instead of the 1,700 as our cash flow, it's 2,214.69. Okay, and all we gotta do, we just do one debt at a time, right? No biggie. And we see that in month 18, oh man, completely paid off. So now we go back to here, which is 18 months, right? And so 15 plus 22, so it's 37K that's paid off, right? 37K. Okay. And so now we got that covered, and then we can go ahead and figure out at 37 months what's the balance of these loans. And I actually don't have to think about this one. I could just put this as zero because it's paid off, right? And so now this one is at 10 grand, right? So 10 grand, 10,057.24. Okay, so let's go ahead and copy that right here, plus 10,057.24. I think that's it, right? So 10,005. So yeah, okay. So now what happens here is that because we're now moving this auto loan, this goes to zero, right? And then now our cash flow has increased to 2678.68, right? So let's go down here and just copy it again, right? And then now we update this to include our new increased cash flow of 2678.68, okay? And then we just copy and paste again, and then we see, whoa, in 22 months, it's gone. These two car loans are gone. So, wait, is it 22 months? Am I high? Did I screw up? Wait a minute, why did I put 37? Hold on. Oh, I screwed up. 18 months. All right, so why did I put 37? Maybe I'm going nuts. Okay, so this is, I don't know why I did that. Well, okay, so let me just retry this again. 17,537.93. So 17, huh? Okay, right here. So 17,537.93, right? Is that it? 17,537.93. Okay, I got too excited. I jumped the gun. Okay. And then we just rinse and repeat over and over again. So let's just do this, 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 this. So a couple more months than we expected. And so that's 25 months till it's paid off, right? So 25 months. And then we go right here. So 25 months. And then I just want to make sure I have the right cash flow in our formulas. Yeah, 2678.68. Okay, great. So hopefully I'm not going too fast. But now it's an extra 24,000. So, whoopsie. Ugh. Ain't nothing but a velocity baking party, and I'm just screwing up. All right, so now it's 37 plus 24, which is 61K. So now we got 61K paid off. Woohoo! In 20. So this is just a little bit. It's 2 years and 1 month. We got 61K paid off. Pretty good, right? And so now this is paid off. And so we don't have to worry about these anymore, but now we got to worry about these student loans. So 25, 25, 25, right? And so as you can see here, right, we can just move this student loan into the line of credit, and we get back, this itty bitty back, cash flow of $212. So let's just go ahead and pay it off, right? So 16613.8. So we just go here. And then this is, I think, the 20,000, right? This $20,000 student loan. So let's go ahead and mark this as zero, and go ahead here and add, okay, and add 16613.8. So, whoopsie, what happened here? So 16613.8, right? Hopefully I did that right. I'm screwing up today. Yeah. Okay. So now let's look at our new cash flow. Okay. So our new cash flow, since this is zero, is 2090.81. How'd that happen? All right. So now let's go ahead and redo the cash flow right here. So minus, scroll up, 2890. 2.81. Take a look at this, 2890.81. All right. All right, so we go down here, and then now, wait a minute. Did I screw up? I did again. So why did I do that? 2890, 2890.81. Okay. So now let's go ahead and copy and paste these, and we see in 31 months the student loan is paid off. Bam. And we're going to go right here. So 31 months, and then it's 61,000 plus this 20,000, so that's 81K. And then now after 31 months, we got to figure out, all right, well, what's the current balance? So this one's paid off, so this is 0. This is 31, 31, and then we see we have $27,000 of this student loan. We're going to focus on this one first, right? So let's just move the 27 to the line of credit. All right, so now if we move this this student loan to the line of credit, we get an extra $354, right? So this $354, this goes to 0. Okay, and now what's our cash flow? Oh my goodness, over $3,000, mind blown, right? So let's go ahead and move this over here. So 27250.99. So let's go back here. So this is going to be plus 27250.99. And then let's go ahead and enter in our new cash flow, which is 3245.17. All right. So now, dang, that's so much. All right. So now let's go ahead and get rid of this student loan, right? And so in month 40, completely gone. So let's go back here. So now this is a month 40, 40 months paid off. And so now we're at 81 plus 35, which I think is 106, but let me just check. 81 plus 105. No, not 105. 81 plus 35. Yeah, it's 116. Okay, good to know. So sometimes y'all catch me on my bad math, right? Y'all catch me. Okay. All right, so let's just keep going. So now we're here at the last month, which is the mortgage. Okay, so the mortgage, and let's figure out at 40 months where we're at the mortgage. Okay, so 40 months, and we can see that barely that principal has been attacked, right? So we start at $200,000, and how much is 40 months? So what's 40 divided by 12? That's about 3 years, and then within 3 years, we didn't really pay that much into the mortgage. We got $187,000 balance, but again, these low payments are deceptive. So what's really important is yes, we pay this off, but we got to pay it off last, because if you don't know anything about mortgages, 3% interest rate at 30 years is actually 50% interest, right? So you pay about $100,000 over the life alone. Now, I know there's some people out there, so well, that's very cheap money, but to me, I don't want to pay 50% interest, even if it's spread out over 30 years, right? And 4% is just a little bit more than that. What, like 60, 70%? I gotta check. Oh, all right. So let's go ahead and do this. So now what we do is we have to do something called chunking the mortgage. So what do I mean by that? We just attack it, basically move the principal of the loan to the line of credit in small amounts. And you could just do it in the size of your paycheck. It doesn't have to be a big amount. Some people say, oh, you should, replace your entire mortgage with the line of credit. And again, mortgages have lower interest rates for a reason, right? Because a loan is a one-way street. And because you don't have access to your money, they know that, like, psychologically, they know that you're not going to overpay it, right? Because of the one-way nature of a mortgage. This is why when people get that letter from the bank, oh my goodness, you can refinance and possibly get a lower monthly payment, or better yet, take out your equity. People are into it because they don't know how to manage their cash flow, right? And that's what why would the bank want you to do something if it wasn't for the bank's benefit? Doesn't make any sense, right? The bank is not altruistic because they have the tallest buildings in the United States. So we have two ways we can attack the mortgage. Number one is directly with our savings, right? And we got plenty of good savings. But here's the thing: talk to the average person, right, who has actual savings, and say, hey, well, how do you feel about dumping your savings into the mortgage? They would freak out, right? So as an alternative, to that, because again, a loan is a one-way street, we can just place some of it in a line of credit and just use this strategy to easily pay it off, right? And so there's two aspects to this. Number one is that it's easy, and easy has a lot of value, right? And a lot of people don't really think about that. It's like, well, the loan interest rate and the line interest rate is so much higher than the loan. But yes, you have two-way access to your money, and you're easily able to pay it off without thinking, right? But there's a lot of value in that too. So, a situation where you have to think that's actually more efficient, but it's not? It's actually when you have to make a left turn. And I don't know about you, but there's a gajillion dollar corporation called UPS that says to its drivers, don't make any left turns. Avoid them as much as possible because they know that left turns are a source of crashes. Same thing with directly overpaying a mortgage, which is why most people don't do it. They intuitively know that they shouldn't do it because it's default. So what we can do is just move, a small amount like $7,000. So this would be like subtracting 7K and it'd be 193, and then you just keep subtracting 7K, which is 180, was it 186, right? So you just rinse and repeat over and over again. That's the entire principle of chunking. But the most important parts is that you do this last because the mortgage provides you the least amount of cash flow for paying it off. So what you're going to do is maximize your cash flow first and then attack the mortgage, okay? Then when you do the chunking part, right? So what you do is just move again like a small amount. There's no like I don't know how to explain this that well, but basically it should be an amount that you feel comfortable with, but that allows you to sleep at night. And so if I have a $50,000 line of credit, I don't want to put the entire $50,000 in, right? So just a small amount that's reasonable. And you can see we just paid off in like 2 years. So you just rinse and repeat again, 7,000, or you could do 10, right? So 10,000, 7,000. I mean, just a small amount that you feel comfortable with. And the more that you put, the more you'll pay in interest just a little bit. But the most important thing that you have to realize is if you put this entire thing into a line of credit, oh man, this is going to be so inefficient, right? So you put this entire mortgage into a line of credit, that's a no bueno. And I'm going to show you with the velocity banking calculator. Luckily, I have access to one. If you're a Renata student, you have access to it as well. In fact, I did a presentation yesterday, and there was a new Renata student, owned 4 rental properties. Talked to her, right? And she was like amazed with the strategy. She's like, I have 4 rental properties, and I had no idea that the average cash flow for a rental property was $200 or good cash flow. She had no idea for 4 rental properties. Smart lady, right? So let's go ahead and open up the Renatus Velocity Banking Calculator. Give me one moment. Okay, here we go. This is the velocity banking calculator. So you just put in your loan details or your loan deets, right? How much you're moving to the line of credit, and then your income and your expenses, everything except for the loan you're trying to pay off, and then this will tell you what you got to know. So we had a $200,000 loan. What's the current balance right now? Let me just quickly take a peek at my other screen. So it is 187,691. So 187,691.58 at 4.5%. Okay. So actually, I'm sorry, not 4%. 4%, 30 years. And then what is the payment? 954.83. So 954.83. Okay. And what is our income? It is 6,500. And what is our expenses? So let me just look at my other screen. It's everything except for the loan we're trying to pay off. So it's the mortgage, and our general expenses now is 2,300. So we fill in 2,300 in this calculator. And again, you might be thinking, where did I get this calculator? I got it from Renatus, where I originally learned velocity banking from. 2017, I originally learned it, and I think they got it from, when I first took their classes, they was like, oh, it's from Australia, and then later I found out that Harj Gill, I think that was his name, came up with the book about the speed equity system, and they didn't call it velocity bingo, or he did it because he was more focused on paying off the mortgage, but I think Renatus is the one that actually came up with the term velocity banking. So, but I first learned it in 2017, and so let me go back here. Yes, original balance, current balance, and then let me just show you something. So the thing that I always like warn people about is that if you got a low interest rate mortgage, okay, and you decide, let me just replace it with the first lien HELOC. Okay, so 187,691 0.58, and the lowest interest rates you can get with a HELOC I've ever seen, especially these days, is like 7%, right? I saw one credit union that offered at 7%. Every other credit union was like 8.5 to 10, and most banks are like 10, right? So let's just assume we're at 10. I replace it, and then it's like, okay, 4.7 years, so we paid it off, and you might think this is really impressive. Wow, we saved 69 grand, okay? But if we just chunk a small amount, again, like $7,000, instead of just replacing the entire thing with our mortgage, take a look here, 4.7 years and 16 grand in interest. So I don't know about you, but if you want to take a little bit longer, right? 0.7 years is not, or zero point 0.6 years is not that much more than, you know, what the other way around. But if you want to pay about 30 something, at least 30 grand and more in interest, you replace your mortgage line of credit. I'm not going to do that. I want to pay it off faster, and I want to pay more interest, and I want to have control of my money, right? So that's why we use a line of credit to help us prevent something called segregation of income, which you could totally look into this YouTube channel for that topic, because we had a great live stream about the topic because someone had sent me in their numbers. And that's how we have velocity banking parties, people. You just send me their numbers. I've because of this YouTube channel, I have so many people send me their finances and spreadsheets, which is funny because when I was like younger, I always thought people were so hush hush about money that they made and their finances. And what I realized is that your closest friends and family members will be hush hush about their finances, but for some reason, random strangers are willing to send you their financial spreadsheets. Like, and I think it relates to the fact that you're not a prophet in your hometown. You ever heard that phrase? Like, you're not a prophet in your hometown. It's. I'm sorry. It appears like 5 times in the Bible. Like, you just take a look at it. It's like, oh my goodness. Like, maybe there's a deep message there because it like, sometimes like you write down stuff and you got to write it down over and over again just to kind of like emphasize it. Maybe that's why it appears 5 times. It's not one of those verses that appears like one time and then people randomly quote it like, well, that's it. No, they actually repeat it like 5 times. I gotta maybe like do a Google search about where it exactly appears. But I remember like being amazed, like, why doesn't anybody talk about this? You're not a prophet in your hometown. Like, I didn't. Maybe that's why I don't live in California anymore, which is where I'm originally from, and where I originally learn about the West Coast and East Coast rap scene, which is funny because both Tupac and Biggie were from the East Coast originally. And I guess I'm doing the same thing as Tupac, which is pretending I'm from the East Coast, even though I'm from the West Coast. So it's like the opposite of what Tupac did, right? He was from New York and I think Baltimore. And then he moved to the West Coast and then decided that he's going to represent West Coast rap, right? Creating Atlanta mentorship. How great is that? Okay, so let me go back here and do this again. And so we'll just $7,000. Now, one thing I do want to mention, some people ask like, well, what's the optimal chunk amount? And I will say this, that the more that you chunk, the more you will pay in interest. So let's say like, oh, you want to do a $20,000 chunk, this is going to go up a little bit because we have to understand that the whole point of the line of credit at this moment is not because the line of credit magically it calculates the same interest as a loan, right? Like the loan interest is based on the statement balance times the interest rate divided by 12, and so is the line of credit. But replace the statement balance with the average daily balance, and it's the same thing. But the whole point of using the line of credit is that if we have so much cash flow that interest rate don't really it doesn't really I don't want to say it doesn't matter, but it's not really that much of a concern, right? So let me just show you this. So let's say I replace this with 30% credit card. So take a look at this, 16 grand, 30%. Oh my goodness, it went up 4 grand, right? So again, you might want to do this with credit card. I'm not saying you should, but I'm just saying like these interest rates, yeah, they kind of matter, but they don't, right? As long as you have the cash flow to offset it. So let me go back here. But you notice that when I use a 30% credit card, it's still cheaper than replacing my mortgage with the 10%. Did you notice that? Like, isn't that crazy? So something we want to think about. But let me just kind of go back here. So some people might think, oh, bigger chunk, that's actually better. It's actually not. So I put 20 grand here. That goes about 2 grand. right? So it's more about a convenience factor and the fact that you don't have to think about it. Because if you do, let's say, a small chunk like 7,000, and you have to kind of always do it every 2 months, for some people that's inconvenient, right? And I always like relate this to balance transfers, right? Like every time you do a balance transfer, you got to pay like that fee, but it's kind of convenient if you just do one big balance transfer at once rather than multiple little balance transfers. So that's the way that you can kind of think of it. That's how much you would want to chunk. So for example, oh, I'm going to chunk 6 months, but I don't really want to think about it after every 6 months rather than every like 2 months, right? Um, so again, if you want to do it that way, you can. I just don't. I'm okay with paying it off every 2 to 3 months, because that's still effective. Yeah, I don't have to think about that as much, and I can prevent that thing called segregation of income, which, I didn't go over too much in this video, but I did go over in other videos. Okay, so now 4.1 years, excellent, and yeah. So, full disclosure, I am an independent contract marketer at Renatus, which is why I keep like mentioning them every of the videos. But I really got to sell their product because I had a Google form, which was essentially a sales funnel, and then I got a little bit lazy and I didn't, I closed it, but I got to reopen it up. All right, so now let's go back to the next form. So let's go back, not form, to the spreadsheet. And so we paid it off in about 4.1 years. So 4.1 times 12 plus 40, right? And then we just divide that number. So 89.2 divided by 12. So what is 89.2 divided by 12? And they'll tell us the number of years. 7.43 years. Okay, so let's go ahead and do that. 7.43 years, and we are debt free, and that's 326K and no mortgage. Oh my goodness. And now at this point we're going to have rich people problems. Rich people problems. You know what rich people problems are? Is that you feel like, oh my goodness, I have all this money in my savings account and I got to invest in something because I'm going to lose it to inflation. But take a look at this. I mean, even if we don't invest, we got 3 grand like piling up every single month, and that's when we have the rich people problem. Or 4 grand, I'm sorry, 4,200 piling up after every single month, and it's like, oh my goodness, what do we do, right? So I'm kind of having that problem right now, but I'm still paying off my debt to my other rental property. So I'm going to pay it off in about 2.5 years, and then I'll have 2 properties paid off. Get the next property, probably pay it off in less than 2.5 years, and make sure I get a discount, and then rinse and repeat. And so get a couple of paid off houses, not deal with that many tenants, and we're good. All right. Well, that's it for today, everybody. Well, this is Korean Atlanta Mentorship. Ooh, we passed the 37-minute mark, right? So again, nothing but a velocity banking party. So get out your spreadsheets, get out your lines of credit, and it's gonna be awesome. That's what we're here for. All right. Well, that's it for today. Have a great day, everybody, and we'll speak next time.